Hey everyone, welcome to our first episode of our new series where we walk through How to Invest by Barry Ritholtz.
Well, we're reading this book together, and it's an interesting read because rather than focus on super great and smart investments or things nobody else can invest in, it focuses on avoiding mistakes. And that's something when Olivia found this book really appealed to me because the biggest problem I see people making are mistakes.
Yeah, this book flips the conversation because it's not about finding the next biggest, best investment. It's about avoiding mistakes that can destroy your wealth. And it's something that I think we should all pay attention to.
Well, the biggest takeaway I see so far in the book of reading, Olivia, is that it focuses on something that's pretty significant. And that is, most people don't do poorly with investing because of bad luck, but rather poor or bad behavior.
And what I like so far about the book is that it says that you don't have to be the smartest person in the world. You just need to avoid being your worst enemy. So avoid listening to the fads of what your friends tell you should invest in.
Well, Coach Charlie Munger, who is Warren Buffett's former partner, he passed away. But Charlie Munger used the word stupid a lot in his clippings. And I always found that remarkable because most people aren't that brash. But he said, really, that's the biggest thing you want to do is avoid being stupid when you go to invest your money.
Yeah, I like that. It's that to be a successful investor, you don't need a secret formula. You just need to stop making emotional reactionary mistakes. I think we're seeing that a lot right now, where people are reacting emotionally to the news and to the market dipping down.
Well, I see that every year, Olivia, and I find it. I don't find it frustrating. I find it's a reoccurring theme. People just have no idea of where it's really taking place, and they get all emotionally charged over absolutely nothing. So somebody comes to me and they're concerned, and I can't just dismiss this saying there's no concern here. But as we're going to delve into it in this presentation, understanding the math makes it different.
So one of the first topics that he brings up in the book, and this is a brand new book, is emotional investing, which is really hitting hard today because of all the noise and the news cycle constantly talking about inflation, all sorts of things going on with the trade wars. I get alerts all day on my phone about this. And I think the constant stream of news articles like this cause people to feel like that they need to react to it.
Well, I know you're getting those notices on your phone. You know how?
Why? Because it asks you.
You text me, Dad, what about this? What about this? What about the inflation? What about the tariffs? So I see it on a regular basis. And so it's really important to know that the news is there to make a profit. And if you and I, Olivia, ran a news station and we had something bad happen in the world and we gave a very logical explanation about why it's not going to be so bad, that wouldn't draw near as many viewers as a tragedy. So the news is there to raise your pulse. And you have a public that doesn't understand investing to begin with. It's just a recipe for emotional investing.
Well, yeah, I think what the public sees is they look at their accounts and they just see the stock market dipping down. And I think that causes a panic for everyone and they want to be I don't know if they want to be out. I don't know if they want to be in a different investment. I think people lose sight of the fact that market is a long-term investment and not a day-to-day investment, in my opinion.
I think you're right. And I think the reason that it makes it hard for the average person to see it as a long-term investment is that they just don't know enough. For example, let's imagine you own a stock today and the stock went down 15% this year. If that's all you knew, that would be pretty traumatic, right? But if you met with me and I said, Olivia, for the last 10 years, this company has seen a 30% increase in sales each and every year. They have a 70% profit margin. They've got their assets are 3 times their liabilities, and sales are up this year. Typically with this stock, the worst it'll ever do is a 40% plunge, and it'll average anywhere between a 5 and a 30% gain per year. Now, if you heard that information, would that give you a different perspective?
Yes, but the problem is that I don't think that information is put out there. It's just the oh, this stock is going down.
Well, we're going to be showing this to clients in our one-on-one meetings. Is really the holdings we have, what their sales are, what their profits are, what their assets are, what the liabilities. You see a company that's had increased sales for the last 5 years of 20 to 30% per year more, profits going up. The stock price doesn't always reflect the value of the company. But over time, highly valued companies will perform very, very well. So a pattern, Olivia, that I've seen is that fear leads to people wanting to sell out, and greed leads to wanting to buy something that's already gone up. And that's a recipe for disaster. Yeah, Olivia, if our clients would follow one of the most preeminent investment houses in the world, Bill Ackman of Pershing Square, you follow even Warren Buffett today, some of those super great investors, and check their emotional level right now. Are they worried right now at this time? What are they doing differently? And you find what these top investment firms, these hedge funds are doing, typically doesn't reflect the pulse of the news whatsoever. And these people have the most amount to lose, and their pulse just isn't that up.
What do you think the main difference is between the hedge fund managers who have the most to lose and an average and everyday investor?
Oh, succinctly and clearly, there's one thing. And there's only one thing, one simple thing. They have a better understanding. They know what they own. Most people don't know that. Most people know a symbol they're bought. They don't understand the company. So these hedge fund managers, I respect so much, they're very successful, are going to have data that we're going to be sharing with clients. We're going to give examples of some of that briefly at the end of this presentation, but they simply know better. If you own a company that sales have gone up tremendously the last 5 years, consistently, companies that have a 70% profit margin, companies that are reinvesting a profit, 70% of the profits are reinvested on an annual basis. How afraid are you about a market dip? So that stock dips in price. Why would you be grossly worried? Probably the thing you'd want to do is find some money to buy some more of that very same stock. You follow me? But you have to know this. You can't be just a visitor or somebody in the stands watching the game. You have to understand the plays the coaches call it.
Okay, so to that point, what about the person who is ready to pull the trigger and get out now, but every time they've reacted emotionally, they've regretted it?
Well, I'll tell you, that poor person is going to lose often, because study after study has been done that shows you can measure the emotions of the public, by the way, Olivia. Studies have been done this, believe it or not. And it shows that when there's the greatest amount of emotional stress in the market, historically, it's the best time to invest in the market. And when there's the greatest euphoria about the market, the greatest excitement about the market,
The worst time.
So it works against you in your human nature. So keep in mind that for every 1 day the market's down, it's up 2 days, 2 out of 3 days it's up. And there's, we have spent a lot of research on trying to find ways to avoid bad markets. And after working it real hard and a lot of study, a lot of money, a lot of time, a lot of effort, I just don't think you can time the market in any way, shape, or form. However, the thing is missing, the person, when they're making this decision and doing it with both hands covered by their eyes, they don't know what they own. So if you own a company, this balance sheet is tremendously strong. Their sales are tremendously strong. They have very little debt. And every year when they're making sales or their profits, they're saving a lot of those. How can you think that's a stock to sell when the price is down? Why would instead you think, gee, I've got such a great stock here that's at a discount. It's on sale right now. Why do I buy this one when it's on sale? Why do I want to make my process? I'm only going to buy stocks when they're at their highest price. So successful investing requires us to do something that may, at the onset, look counterintuitive. But I think, Olivia, what we're going to teach clients over the next year, we're going to start taking to the balance sheets of all these companies we're buying and let them see what's going on. And we're going to do a little test experiment on this call here today. And I want you to tell me if it gives you comfort or a different perspective. For one thing, Olivia, the market's now not that unusual right now. It's common to have a 10% reset or drop at least once a year. So that's not uncommon. But the idea of selling out is kind of like you build your dream home, right? Your dream home, the dream location, the dream appliances, everything about your dream. And you come home one day, it's raining, and it sprung a leak in the ceiling in the kitchen. Do you sell the house?
That's a good analogy.
You got a good house, just fix the roof. We have a great portfolio for our clients. The ride's not going to be like this. are like this, it's going to be like this. But give ourselves some time, understand what we own. I think not only will we do better as advisors for our clients, Olivia, I think we can get our clients some understanding. And that's really my hope over the next few weeks in meeting with clients is to have them understand why we're in a good spot. So one thing I've gathered in the first two chapters is that emotional investing is one thing that can really erode your net worth, particularly if it's supported by the fuel of the bad news. What do you think?
Yeah, I think the news is loud, and I think that that's really the only source of most people's education about the stock market. So I think what we're doing here and explaining, going through in future episodes about going through the balance sheets and stuff, I think that's going to just open up our clients' minds, and really we're going to focus on that education, which is I think why most of our clients, the majority, aren't worried, because we have spent a lot of time educating them.
Yeah, I think it's really key is knowing, and it just dawned on me, I guess, earlier this last week when I was sharing with you some of the reports, the balance sheets, and I realized, man, maybe we should show clients this information as well, because it's part of the reason that I'm as confident as I am, is I know what we're on, I know where we stand, and so we'll be excited to continue going through this book and sharing some takeaways as the weeks unfold. And I'm going to share with you a couple examples of the company's balance sheet and how that can affect maybe your perspective of whether you should own that company or sell that company. And Olivia, I'm looking forward to you asking me a lot of good, fun, interesting, and tough questions here in just a moment.
Yeah, so let's take a look at those balance sheets that you were talking about to give a couple examples.
Yeah, I want your opinion on this. But by the way, so Olivia's not seen this as of yet, so this will be her first time, her eyes first time to glance this. All right, Olivia. So this is a stock that we don't own. I'm going to show stocks today that we don't own. When we meet with clients, we'll show them our own stocks. But the first thing that you want to look at with a company, the first thing is what are their sales? And consistency is very, very valuable. A company that has very, very dynamic change in sales from year to year, Wall Street doesn't like as much. I don't like as much. I like consistency. In all of investing, we want consistency. So if you look over here, back in 2015, their sales were $224 million. And then 16, they were 329, 433, 566, 737, 841, 1055, 1375, and 1693. First glance, without using a calculator, would you say that is pretty consistent growth?
Yes.
So if that's all you knew about your company, would that give you greater confidence? Let's say your stock price is down this year, but you see your sales are going up that much year over year. How would that affect your confidence level in your position?
It gives you peace of mind because based on the history of almost 10 years, they're consistently increasing.
Now, how about this? Their gross profit margin is 83%. So you own a company that has an 83% gross profit margin. Their net margin they're making is 20%.
Mm-hmm.
Okay. So now let's go look at the balance sheet, which shows their assets and their liabilities. Their current assets are $5,859,000,000. And look what assets have done over the years. You see the same type of scale as the sales, right?
Right.
So as you read this and you see, hey, the sales are going up, their assets are going up consistently now, does it leave you feeling any more confident?
Yeah, absolutely. It seems like a really strong company.
You look at their current liabilities, the current assets up here are $5.8 billion, and their current liabilities are $4.2 billion. So they've got $1.5 billion in shareholder equity. Their free cash flow was $341 million last year. They saved $341 million the previous year. And that, just going over the last number of years here, the last 10 years, you see that the amount of money they've saved has consistently gone up year after year. So when you look at all those things, the assets they have after the net worth they have, their free cash flow, their profit margin, their ever consistently growth in sales, their consistent saving money. How do you feel about this company? How confident are you with it?
Yeah, that sounds like a confident investment to me, with the strength of the company, the growth. It's consistently increasing.
So in the last
over a long period of time.
In the last year, 10 years, it's made 540%, and the market's made 150. So that's over 300% more than the market made.
Mm-hmm.
Now, it's not one that we at JCN own, because We had some picks we felt were better than this one to put in our portfolio. Something else I really want to bring attention to that I think you would, as an investor, be helpful. You know, this position, Olivia, the estimated maximum drawdown, which is how much the quant model, this is the engineers that determine these variables. This is how much the stock could decline in any given 1 year bear market scenario over the long term based on current information. So you can see as much as a 43% drop in this stock. That would be
Wow.
expected. And annualized, make anywhere from -4 to +19 per year. And again, it made 540 in the last 10 years. So if you own this stock today, we don't own it, but if you didn't own it and you were down 15%, how much sense would it make to sell it?
None.
As a matter of fact, if it were down 43%, could you think of a stronger argument as to why you should buy more? I mean, if you own this position and it's down 43% today with these financials, you're buying it at a fire sale.
I think a lot of people don't have the stomach to watch it go down to 43% without knowing the other facts about the balance sheets. If they're just basing it off of watching it go down and watching your account value go down, and then they emotionally react and sell that, and then they miss out on that return over time, I could see why that could be a recipe for disaster.
That was my thought. I thought, and you know, you're not investing money here at JCN as of yet, so you don't have a whole lot more knowledge than our clients. So I thought you'd be good to show you some of the balance sheet information. And I'm not as my baby girl. I don't want you to agree. Just agree with Dad. But as a little consumer over there in Houston, Texas, how demonstrative is this balance sheet information to you in terms of knowing whether you want to own a stock or not?
I think it's the most important part of it.
Well, we're going to be showing our clients in our one-on-one meetings our portfolio. I'm really looking forward to it because this is not a bad bear market. We're barely in a bear market right now. And if we get real ruffled or feathers about this, a really tough market to really make, I guess, kind of glued at the seams. And every stock we buy right now, Olivia, the balance sheets are very strong on them. So we're going to be showing this to clients.
I think they need to know for sure. All right. So I think what the biggest takeaway for me personally is the best investors aren't the ones trying to time the market. They're the ones that avoid the biggest mistakes, which goes hand in hand of what you always say. It's easier to avoid a mistake than to fix one. So I'm interested in learning more with you and to educating our clients, because I think it's the most important time. They really need to hear and to see these things that we're showing, because I think it provides a big peace of mind.
Yeah, this is the time I enjoy most in our business because we're in a position to make a difference in people's lives. And I think the newest thought here is teaching balance sheet information. If it makes an impact on you, it's going to make an impact on other people as well. These videos are a little longer than I normally do, but I ask you as my client, please watch them because I can't help you if you don't participate. And shoot me an email or text message or call me and let me know if this is hitting home. All righty. Well, until next week, over and out.
All right. Bye.
Bye.